Please note, this session is closed to the press. The views and strategies described herein may not be suitable for all clients and are subject to investment risks. Certain opinions, estimates, investment strategies, and views expressed in this document constitute our judgment based on current market conditions and are subject to change without notice. This material should not be regarded as research or as a J.P. Morgan research report. The information contained herein should not be relied upon in isolation for the purpose of making an investment decision. More complete information is available, including product profiles, which discuss risks, benefits, liquidity, and other matters of interest. For more information on any of the investment ideas and products illustrated herein, please contact your J.P. Morgan representative. Investing involves market risk, including possible loss of principal, and there is no guarantee that investment objectives will be achieved. Past performance is not a guarantee of future results. This discussion is for informational purposes only. The speaker's opinions belong to them and may differ from opinions of J.P. Morgan Securities LLC and its affiliates. Views presented on this webcast are those of the speakers. They are as of January 23rd, 2025, and they may not materialize. This is not an investment research call and is not personal investment advice or solicitation or recommendation. Investment products are not bank deposit products, which means they are not guaranteed by a bank, not FDIC insured, and have risks, like the possibility of losing money on your investment. J.P. Morgan Chase & Company and its affiliates do not provide tax, legal, or accounting advice. This material has been prepared for informational purposes only and is not intended to provide and should not be relied on for tax, legal, or accounting advice. You should consult your personal tax, legal, and accounting advisors for advice before engaging in any transaction. Asset allocation diversification does not guarantee a profit or protect against a loss. The webcast may now begin.
Good morning and good afternoon, everybody. My name is Brian Blagden. I lead our investment specialist teams here with JP Morgan Wealth Management and super excited to be kicking off 2025's JP Morgan Wealth Management webcast today. I'm joined by two great colleagues, Annalise Ozenbaugh, who is the head of investment strategy for JP Morgan Wealth Management, as well as Sarah Daya, part of our wealth planning and advice team. So when we were thinking about how can we kick off 2025, we decided to take a little bit different of an approach for today's webcast. And I want to thank each and every one of you for joining us today, but also sharing your questions. One of the biggest pieces of feedback we've received over the last couple of years doing these webcasts is I'd love to ask some questions. I'd love to know a little bit more about what's affecting me, what's affecting those around me in my local communities as well. So what we decided to do, going back to last week when we sent out this invite, was open it up to provide questions. So we've been vigorously taking those in and trying to craft that into a great narrative today so that we can incorporate those questions, try to give you a lot of that great information that's pertinent to you in your financial situations, both on the markets and economy side, as well as tax implications and what that looks like. And given the fact that today or this week has been quite a busy week, I think it's just very, very timely, and we're super excited to have today's call. So the way that the agenda is going to be is we're going to open it up, kind of give a foundation. Where are we in 2025? We're then going to think about some of the updated things that have taken place this week alone as we have a new transition in the White House and incorporating some of those different pieces of legislation, executive orders that have taken place this week. And what does that mean to each and every one of you as we think through that today? And then we're going to go into some other questions related to both taxes based upon our 2025 outlook and where we see rates and equities and a lot of that great stuff. So I hope everybody's excited. I will say that given the range of scope that we're going to cover today, we may go in a couple different spots, but I think we're going to cover a lot of great stuff and it'll be a very, very thoughtful call. So with that said, I do want to bring Elise into the fold, and we're going to start with just level setting. Back in early November, we released our 2025 outlook that comes from Elise and her team. So given that we've done that, Elise, in November, and now we've actually had a pretty busy January in 2025, where do we stand today as we come off of 2024 and we lean into 2025? Elise, over to you.
Thanks so much, Brian, and hello, everybody. So when we think about our outlook for 2025, I want to ground us in kind of our starting point, which is that we see a really constructive balance in the macro backdrop. as you've seen all around the world, inflation come back down at least towards those global central bank targets. That's really happened as growth has pretty much balanced out and kind of settled at this trend-like level. We think that those trends can persist, and they've been both enabled and we expect to continue to be supported by the fact that we've had this global monetary policy easing cycle. And just using the Federal Reserve as the key example, note that interest rates in the United States, or that policy rate, has already come down by a full percentage point. That should continue to support economic growth without reigniting inflation. And then you also have these dynamics on the fiscal policy side and the regulatory policy side, where we see the potential for the new administration to potentially do things like pursue the extension of tax cuts that are currently in place, and also perhaps kind of create a backdrop of a less onerous regulatory environment. So both of those dynamics are also likely to be market friendly. And all of these things together, we think, offer that foundation. When you think about where we've been over the past couple of years, it's really important to acknowledge just how strong returns have been. 2023, you saw the S&P 500 generate a total return of around 26%. And then last year in 2024, there was another 25% total return year. Those back-to-back returns are the best sort of streak that we've seen since the late 90s. And I think the key takeaway for investors is that it hopefully gives you a really strong sort of starting point upon which we can build. So as we focus on building this strength, we really want to do two things simultaneously. One is continuing to lean into opportunities where we see them to continue potentially capturing that upside. But the other is to really focus on renewing your portfolio's resilience. So that might mean right-sizing positions that have gotten kind of out of balance, or it could be taking a good look at the way your portfolio is diversified to make sure that you have different levers in there that are going to help defend against the variety of risks that could potentially derail our otherwise optimistic base case view.
Elise, that was well said. And I think that last piece around building resilient portfolios, given the fact that we have seen a nice run up over the last couple of years in the equity markets, that understanding that balance in your risk tolerance based upon the plans that you're working with your advisors is very, very important. So thank you for that. So Sarah, now bringing you into the fold, and again, this back and forth with what's going on in the markets, but then how does this play out within tax policy and different implications there? Now, every year, there's always some slight changes, but given that there's a shift in the White House, those become far more magnified. So as you see just level setting with your thoughts on this as it relates to tax implications, how are you grounded in 2025?
Yeah, thanks, Brian, and good morning, everybody. 2025 is really going to be a big year for taxes and tax policy as well, right? So if we take this back two administrations. In the first Trump administration, we had the passage of the Tax Cuts and Jobs Act, and a number of those provisions from 2017 are set to expire at the end of 2025. What we know isn't expiring is the corporate tax rate. So that corporate tax rate will stay at 21% for now, and we'll talk a little bit more about that, as we move towards today's conversation. But in order for that original bill and the tax cuts within that bill to really be passed with a simple majority of votes and avoid a filibuster, the provisions did need to lapse at some point. And right now, those were set, most of them were set to lapse somewhere between that 7 and 10 year period, which is where we get to today in 2025, that a vast majority of the Tax Cuts and Jobs Act provisions are scheduled to sunset at the end of this year. The income tax rates are set to change. The estate and gift tax exemption amounts are set to change. We're anticipating changes to the standard deduction, SALT limitations, QBI, and a number of other provisions. I think there's something like 23 different provisions that are set to sunset unless Congress acts. And now that we have a new Congress seated and a president sworn in, we wait and see what those new proposals are and how they tie into some of those fiscal and regulatory policies that Elise was alluding to here a few minutes ago. I will say that, historically, we've gotten tax bills in the fall. And even in 2017, when Tax Cuts and Jobs Act was passed, it was passed on December 22nd, 2017. So it was at the end of the year. So I think we're sort of in this period of wait and see, and let's see what Tax Cuts and Jobs Act is going to look like, what those policy proposals are going to look like. But in the meantime, there are always going to be planning opportunities that we want to take advantage of. And that's really where I think, for most of 2025, my focus is going to be.
Sarah, thank you for that. I appreciate it. And just given the fact that I know we're going to talk about this a little bit more, can you just explain briefly that acronym SALT for everybody?
Oh, sorry about that. Yeah, we tend to use a lot of acronyms. It's the state and local tax deduction. So there is a deduction that taxpayers are able to take for local income taxes, state income taxes, real estate taxes. And right now, when we say SALT deduction, we're talking about that limitation. It's capped at $10,000. And so for those of you who are in those high income tax states or states that have high property taxes, this particular provision, I think, is going to hold a lot of weight in terms of what happens with it.
Perfect. Thank you so much for clarifying that. Okay, Elise, so diving into these great questions, and the next few questions we're going to talk through are just very relevant and timely for this week. And I think the first one that we're going to start at, just because, again, there was more action on this yesterday. Now, let's begin with immigration. A national emergency was declared at the southern border. So when we think about this, there's obviously the emotional impact of this, but when we think about this as it pertains to markets, economies, and people's financial circumstances, how does that play out, or what are we seeing so far in just the early days of this?
Got it. So, Brian, I so appreciate that sort of caveat, because as investment strategists, we always try to take the most objective look possible at what's going on and then assess what implications that's going to have for our view on the economy and or markets. And I think in the case of changing immigration policy, the most direct tie I see is probably to the labor market. So I want to ground us in the perspective of what immigrant workers kind of represent in the context of that broader U.S. workforce. The estimates that I have seen suggest that somewhere between like 7 to 10% of the U.S. workforce is comprised of undocumented workers. Now, those workers are estimated to be overrepresented in certain states, namely California, Texas, Nevada, New Jersey, and Washington. From there, we can also look at this at, the sector level. And when you do that, you tend to find that these undocumented workers are largely concentrated or overrepresented in certain job categories like agriculture, roofing, and painting, to call out a few examples. So as we've been discussing this here on our desk, the conclusion that we've started to draw is that to the extent that you start to see deportations actually executed as advertised, the effect on the labor market, might be most acutely observed either in specific geographies or sectors rather than at a meaningful degree at the national level. Regardless, though, the risk is really that deportations and a slowdown in immigration could lead to a revival of tightness in the labor market, or that mismatch in the supply of workers, like having too little of them for the amount of labor demand that there is out there. But when I think through kind of the reasons as to why this isn't something that's currently changing this base case call that we have for the continued restoration of economic balance and ongoing expansion, it kind of boils down to 3 points. So number one, for this to meaningfully impact the labor market to a high degree, we would need to see a lot of effectiveness and execution. And this is a hard thing, quite frankly, to execute. And by the way, it comes with a price tag. I saw an estimate from the Immigration Council that projected that it could cost roughly $88 billion per year to implement. And I'm just not sure how politically palatable that might be in an administration that's so focused on cutting government outlays. That kind of brings me to the second point, which is a historical example that our chairman of investment strategy, Michael Semblist, called out in one of his recent papers. So when you look back over history, under Eisenhower, there was a period when annual deportations peaked at over 1 million per year, and that included both documented and undocumented workers. But then when you look at what happened afterwards, it was just 2 years later that you saw that figure fall by over 90% to just 80,000 because funding and support for the deportation program evaporated. So takeaway in this regard is that, this might not be something that lasts forever. It could be a response to the recent dynamics we've seen in terms of the surge of immigration. Time will tell. Third and final point that I think is worth acknowledging is that Trump has said before that he doesn't oppose legal immigration. So if you do start to see labor supply get squeezed and we don't have enough workers, you could potentially allow that legal immigration to increase in order to kind of replenish that labor force. So on net, while we might see some impacts at the margin, we do still think this trend of labor market rebalancing and the enablement that that's giving for inflation to continue to come down, we think that's going to persist.
Wonderful. Thanks, Elise. So this will definitely be one of those that you will be focusing on and following quite often, just kind of see how it unfolds, how prevalent it actually becomes, and what effects will take place. Would that be fair to say?
Certainly.
Perfect. Okay, so moving into a follow-up question to this, and this is one that has been kind of a moving goalpost over the last probably several weeks or so as it relates to tariffs. Now, some of the different proposals that have been put out there, Trump potentially saying 25% tariffs on Mexico and Canada as soon as February 1st. There's also been kind of different shifts on that as it relates to China. So when we think about just where we are today, Thursday, January 23rd, what is the perspective that we are taking here with JP Morgan as it relates to tariffs? Obviously, this is a topic of conversation in Davos going on this week as well. What is your team thinking through how this relates to the overall economy?
Yeah, so as of the current moment in time, January 23rd, no tariffs have actually been implemented at this point. But as you mentioned, Brian, the president has kind of continued this threat to impose tariffs on the U.S. top trading partners, including Mexico, Canada, China, and even perhaps the European Union. And as you also mentioned, that could potentially happen as soon as next week. First and foremost, let's acknowledge why tariffs are being pursued. And we think that it's largely driven by, a concern for supply chain security and economic competitiveness. For that reason, we do expect the U.S. to likely increase tariff rates on imports from China, and that's incorporated into our inflation outlook for this year and next already. The reason why China is the one that we think is most likely to come to fruition is that China has this dominance in certain key industries that could be perceived as a strategic risk to that U.S. economic competitiveness. I mean, you think about the fact that they're the world's largest exporter. They control roughly 90% of rare earth mineral extraction and processing. They control nearly 40% of semiconductor assembly and over 3/4 of battery production. So keep an eye on the tariffs that end up getting imposed on China. We're not sure exactly what those are going to look like yet, but we are assuming that those go up. Now, as for these threats of tariffs potentially getting imposed on trading partners like Mexico and Canada, I do think that's a little less clear. I think the strength with which the president continues to mention this is somewhat surprising to us. But ultimately, it seems like the consensus across Wall Street aligns with our own view, which is that this very well might just be something of a bargaining trip, as it was during Trump's first term, by the way. He made similar threats on Mexico and Canada, but ultimately didn't end up implementing those tariffs. You're seeing this reflected in markets as well. Canadian and Mexican equities have been rallying this week, so have European equities. And I think it is a reflection of the market grappling with that uncertainty and just really trying to suss out the likelihood of what will get imposed. Nevertheless, again, kind of rooting us back into that investments perspective, we talked about how it could potentially be a boost to inflation, but a one-time boost. And I think it's also worth calling out that, it could in some ways boost investment in industrial capacity here in the United States over time. So all in all, I do think that the tariff talk and the potential changes to trade policy do support our view that the U.S. stock market is going to outperform the rest of the world in 2025. It is one of the reasons why we have revised our outlook for Treasury yields a little bit higher for the year ahead. And we also think that this is going to be overall supportive for the US dollar. So packaging it all together, this could make that trend of US exceptionalism persist even longer.
Gotcha. So in that case, then we will definitely be looking at the US dollar and what impacts that would potentially have in 2025. So thank you for those comments. Now, this last one I'm going to pass your way is we got a lot of questions as it related to government debt, spending, and those types of things over the last week or so. So just to try to incorporate this as best as we can, right? When we think about government spending, we think about debt and deficits, but also this new office that we hear Elon Musk talking about, the Department of Government Efficiency, DOGE, I believe is the short acronym for that. How do we think through that in a couple of minutes here, just how that relates to 2025? And quite frankly, just given the outlook that your team put out in 2024, which I believe incorporated some of this in it as well.
Sure. So focusing first on the executive orders that have already come out, some of them include things like a hiring freeze on federal employees, mandating a return to office for those employees, presumably to trigger some voluntary employee departures. So it seems like kind of streamlining the federal workforce is viewed as a key part of the efficiency initiative. But I want to make sure that we're being realistic about how much efficiency that's actually going to create, because this idea that government employment is overly bloated might be a little bit overblown when you consider that federal employment represents the lowest share of total US employment in 85 years. To put some dollar figures around this, you would also need to fire over 500,000 of those federal employees to save just $50 billion on federal employment, compared to the roughly $6.8 trillion that the government spent last year. So that kind of segues then into the broader discussion. And I think the motivation as to why they are so focused on efficiency, and that kind of comes down to the fact that, the government spends more than it takes in. We run deficits. And up to this point, the US privilege as the world's reserve currency has kind of prevented that from becoming a problem, because when our government wants to borrow money, they go out, they issue treasury bonds, and there are still plenty of people there to buy them. We don't think that that privilege is going away anytime soon, but this is a risk that we're really continuing to watch, particularly given that overall, we just don't see a lot of fat for the government to trim in terms of spending beyond the discretionary programs that they run. If you're really going to make a meaningful splash in outlays because you don't want to do something like raise revenues via taxes, then you might have to start looking at entitlement programs like Medicare, Medicaid, Social Security, and those are, very politically sensitive. So when we think about this risk, not necessarily being one that we're super concerned about in the present, but something that we do want to watch longer term, we're thinking through ways that we can complement those traditional diversified stock bond portfolios to potentially have some defensiveness against any sort of fallout that you would expect to come as a result. And the idea that always comes top of my mind is something like gold. It might not be for everyone, but it could be worth considering for you to the extent that you do want to have an additional diversifier.
Wonderful. Thank you for that, Elise. So 30 seconds just to kind of recap, because we said a lot here. Great questions. But there's a lot of wait and see, I think, that's playing into this. The second piece of this is just based upon our outlook and understanding that we've seen Trump 1.0 and now we're seeing 2.0. Some of those things staying similar and just understanding that a little bit better than a brand new transition in the White House being there. And it sounds like some of that is already baked into our outlook for 2025. Just high level, very specific, what are the investment ramifications that you're thinking through just based upon the three things we just covered there?
I think it means that we all need to be prepared for the potential of headline-driven volatility. As you pointed out, directionally, a lot of the things that are starting to happen or that are being promised are consistent with that Trump campaign platform. So we have already incorporated them into our base case, but especially after a couple of years where volatility in markets has been relatively low, we just need to be prepared to really sift through the noise and navigate volatility with that goals-based perspective kind of front in mind in the context of what it is we're trying to achieve with our money longer term.
Perfect. And I think that is a perfect segue and transition into planning, right? I mean, it's important to have a plan, right? All the things that we just talked about, economic implications, investment implications, are very important. But at the end of the day, as long as we understand where we're trying to go with the money that we've accumulated and continue to do so, is really what sets our foundation. So Sarah, bringing you into the fold and now starting to talk about tax implications and some of these different things, for everybody, buckle up, right? This is one of those very, very important things to all of us. There's a lot of value we can get through investments. There's a ton of value we can get through planning appropriately. So Sarah, just bringing you in and kind of getting things started, what are we thinking through as it relates to just individual and corporate taxpayers just driving into 2025?
I think the biggest thing here, right, is the idea of extending the provisions of Tax Cuts and Jobs Act. As I mentioned at the beginning, a majority of those provisions are set to expire on December 31st of this year. And that does create a level of some uncertainty in terms of, what taxpayers should be thinking about in terms of what their tax bills are going to look like in the future. What do their portfolios look like? How can we be tax efficient? All of those things. Just to kind of give all of you a flavor in terms of what's on the table right now is income tax rates rising to 39.6% from the 37% we're at. The alternative minimum tax exemption, that AMT exemption that you're probably heard of, is set to drop, which would subject more taxpayers to the AMT. The qualified business income deduction, the QBI, that's a brand new deduction that was specific for pass-through business owners under Tax Cuts and Jobs Act, and that's currently set to go away. The estate and gift tax exemption, right, is at its highest levels that it's ever been at before, so a prime opportunity to plan for that estate and gift tax piece of it. And then, not all of the things that are set to expire are taxpayer unfavorable. So if we look at some of the taxpayer favorable things, that SALT cap that I mentioned at the beginning, right? The state and local tax deduction cap, right now that's at $10,000. And so if TCJA does expire, that $10,000 cap does go away. Miscellaneous deductions would come back, personal exemptions would come back. And I think that these are really extending these parts of Tax Cuts and Jobs Act really is what the administration's priority is going to be for 2025, right? Because they do have to proactively act in order for these to not expire. I think we heard, on the campaign trail and in news conferences, things like reducing the corporate tax rate from 21% down to 15%, increasing the child tax credit, eliminating taxes on tips, overtime, and Social Security. So there is, I think, a lot that's on the table, even outside of the TCJA provisions that I think are a priority. But going back to, some of Elisa's comments when she was talking about DOGE and the spending and the deficit, we've got those concerns, and funding some of these tax cuts are going to be part of those conversations. And so while I think the TCJA piece is the priority, as taxpayers, both individual and corporate taxpayers, it's really going to be a wait and see on where some of these other items fall in terms of the priority list for the administration. Perfect.
So with that said, and just thinking, I'm going to use this acronym now, SALT, right? State and local tax deductions. We did get questions from clients in particular states, right? New Jersey, New York, California, where I'm at, right? So some of those high, state tax states, how can we plan for that? Is there some things or some tactics that you're thinking through from a planning perspective that can, help out?
Yeah. So, right now, there's really four options that are on the table. There is that the cap is going to go up from 10,000 to some other higher amount. The cap is going to go down, right? They'll take it from 10,000 to an even lower amount. We're going to get rid of the cap completely, or we're just going to get rid of the state and local tax deduction in its entirety. Depending on which one of those we're sort of planning for, there are things that we can think about. So let's say that the cap goes down, right? And we go from 5,000 or 10,000 to it either gets eliminated, maybe goes to 5,000. we really want to think about bunching together any future deductions that we'll have, because your deductions are more important in a year where you have higher tax liability. And so thinking about charitable giving, are you giving every year a certain amount? Is there a way to maybe bunch those charitable deductions together to take them in the year that you need it? Moving to a low-cost state, that's something that comes up often. And it doesn't have to be a state where there's no state income tax, but if you are in a state like New York or a state like California where we have significantly higher local taxes, is there appetite to maybe relocate? We want to think about investing in tax efficient assets so that the income that's being generated is lower. That's going to bring down your overall taxable income. For business owners, does it make sense to maybe change your business ownership structure so that you're able to take some additional deductions more at the business level versus on the individual level? So those are all going to be things to keep in mind. If the cap does go up, right, and we go from 10,000 to 20,000, 50,000, or whatever that increased cap is, and I'm going to caveat this by saying, again, some of the potential changes, I think we're still in this place where we're probably not going to have a filibuster-proof majority of 60 votes in the Senate. So some of these still may be temporary, but let's say we do get into that world where the cap goes up or the cap is eliminated. We're going to want to take advantage of having that cap eliminated or that cap higher, right? So what we're going to want to do is, instead of bunching together deductions, we're going to want to accelerate some income. Maybe now is going to be the time that we recognize some additional income that may have been deferred. Maybe we recognize some capital gains because we know we have an opportunity to take advantage of that larger SALT deduction to minimize the amount of overall taxable income that you have.
Gotcha. Okay. Now, when we think about some of those things, right, and those deductions, now pivoting a little bit, and we had a few questions as it related to just kind of transfer of wealth too, right, when we think about estate taxes. So when we think about trying to be as efficient as possible, but also some slight unknowns, what those would look and feel like, how do you plan for something that is not concrete, but potentially could change? So how do you think through that as in the context of transfer of wealth to heirs and so forth?
I think that's a really good question. And I know that there are a lot of clients on the call who have that same concern, right? That we don't want to give away assets in the form of a gift if we don't think there are going to be changes that happen, right? But again, like knowing that Tax Cuts and Jobs Act is set to expire at the end of December, and the Tax Cuts and Jobs Act in 2017 didn't get passed until December, it's really hard to say, let's wait until December to do everything. And so my advice for clients who are in this situation, right, is continue planning. We want to continue to have these conversations. We want to have the time to think through what those right structures are going to be. If we're utilizing trusts, or we're utilizing, family limited partnership type structures, or other vehicles to do some of this efficient wealth transfer, we want to make sure we have that plan in place and we've got the documents drafted, we've got the structures built out, and then let's pause. And that pause helps because I think the passage of time is just going to give us a little bit more clarity in terms of where some of those estate and gift tax provisions do fall, on that list for the administration. But I think the key here is really taking the time to plan and then pausing before we actually fund any of those transfers.
Gotcha. Again, back to the power of planning and why it's so important to start there. Once we have the plan in place, we understand where we want to go, and then we start putting the other puzzle pieces together. So for the sake of time, I do want to put two questions together that one is just a strategy question, and then two is what, quite frankly, was talked about quite a bit on the campaign trail, but just leaning into this idea of, Roth conversions and things of that nature. We got quite a few questions just related, like timing wise, considerations, things like that. But the other piece that I also want to add on to this is just, we heard a lot about capital gains tax. What does that mean? And you leaned into this a little bit earlier of like, how do we pay for some of the deficits or some of these tax cuts? So those two questions, if we can maybe talk through those, and then we'll keep rolling.
Yeah, no, so on the capital gains piece of it, right? Like what we really want to think about is where are tax rates going? And so if the rates do, in a world where the rates go up, what we're going to start thinking about is putting more into some of these tax advantaged accounts, right? And the beauty of the tax advantage accounts, like your 401k or your IRA, is we're really kicking that can down the road in terms of taxes to some point in the future. Hopefully when you're in a lower tax bracket as you're withdrawing some of those assets. So that's really what the thought is going to be there. And if rates go down, right, if we go from capital gains being where they're at today to something substantially lower, it's just the opposite side of that, where maybe we're putting more into those taxable accounts because we want to take advantage of those lower tax rates. And then the same conversation with sort of the Roth conversion piece of it, right? When we're talking about Roth conversions, and I think this is a conversation that I probably have on a daily basis with clients who have large IRA balances, it's really thinking about where you're at today in terms of your tax landscape versus where you may be in the future. And so it's always balancing, what that effective tax rate is going to be. And so we're today in this world where the top rate is at 37%. And, like I said, if Tax Cuts and Jobs Act does expire, it'll go to 39.6%. Depending on where you fall within that today, if we think you're going to be in a lower bracket today, makes sense to convert, right? But if we think that based on what your retirement income is going to look like 5 years from now, when you have to start pulling money out of your IRA accounts, maybe not the best idea to convert. The other things that you want to keep in mind is, when you convert and you pay the taxes today, what assets are we using to pay those taxes? We want to make sure that we've got enough cash outside of that conversion amount in that retirement account to pay those taxes, because we want to build in we want to make sure that whatever you're converting ends up in that Roth vehicle to take advantage of that tax advantaged account. And then the last piece is, really going to be, or the two last pieces are going to be the need for required minimum distributions from the accounts. If you're going to be pulling money out of that account anyways, maybe it just makes more sense to defer it until we pull it out and pay the taxes then and not do the conversion. But if on the flip side, you're not going to need to touch that money and you're thinking more long-term legacy for your kids, grandkids, great-grandkids, the best type of asset to inherit is something that's a tax-free asset, right? And so that's really where we come back to, it does make sense to do a conversion. So it's really this balancing act. And, our JP Morgan advisors are well equipped to kind of help navigate someone through that conversation of where they fall sort of on those different factors.
I think that's fantastic. Thank you so much, Sarah. So we'll give you a breather here for a second. And this is where we kind of had it set up for the speed round. And then as I look at this question, Elise, and I think about speed, so can you do your best 30-second answer as it relates to where rates are heading in 2025? Is the Fed going to cut, hike, keep rates steady for 2025? I don't think this is a 30-second answer, but we'll see what we can come up with.
I'll give you a 30-second answer. So our base case says the Fed is going to cut and that they'll cut 3 times in 2025. Not expecting a cut at the January meeting next week. And the qualifier I will add is that when you think about the balance of risks, I think that risk is skewed towards the Fed cutting less and not more than 3 times, largely given economic resilience and the potential for inflationary impulses to come about as a result of things like tariffs.
That was pretty good. Well done. So speaking of that, let's just do a quick shift then. So we talk about fixed income, expectations for the S&P at the end of the year. Now, we started off with, we had our base case and our outlook in mid-November. We talked about some of these political implications that took place this week. Are we holding tight with what that was? Does that still feel right? What our expectations are for the end of 2025?
It does. So that expectation is that the S&P 500 will continue to rally, but not to the degree that you saw in 2023 and 2024, because that was really exceptional. The guidance I would give investors based on our baseline expectations is that we're looking for high single-digit upside from the S&P 500, comprised of both price appreciation, but also dividends. And we think that earnings growth is going to have to do the heavy lifting, given how high valuations are right now, because those are, above historical averages.
Fantastic. Thank you, Elise. So Sarah, over to you. A couple quick follow-up questions just as it relates to the comments you recently made. When we have tax implications and tax changes, sometimes they could be retroactive, right? It's not necessarily that it takes place on the day that it says February 1st as a broad example. So is there anything that would be potentially retroactive to 2024 that we would want to keep our eye on?
It's highly unlikely. If we see a bill come in December, my guess is it would be retroactive to January 1 of this year, but highly unlikely for anything to be retroactive to 2024.
Perfect. Thank you for clarifying that. And then the other piece of this that we get quite a few questions on, just as it relates to Social Security, what does that look like, feel like? Is there some relief there? Just thoughts that you and your team have, just given the current landscape?
Yeah, I mean, we heard a lot about that, right? The relief from Social Security, and so will there be any? It's maybe. We come back sort of to the costs and how much this is going to add to the deficit, and how it's going to impact, funding Social Security and Medicare in the future. Because keep in mind, like Social Security taxes are used to partly fund Social Security and Medicare, and so if we eliminate those taxes, if we're going to continue to fund those, we have to find the funding somewhere. So I think right now it's another one of those to be determined.
Gotcha. So we'll definitely keep an eye on that one and probably come back to that on one of these calls, I'm sure. So Elise, this next question, honestly, I could have asked it, but I'm glad somebody else did as well, just coming from leading our investment specialist team here. When we think about the markets, one of the big questions we get, and obviously we got it quite a bit here, was, what are we excited about? What are we looking at? What are some of those things in the current environment that we're like, those are some very creative, possibly potential opportunities that we can think about incorporating it into our portfolios?
Yeah, I'll focus on the equity story, and in particular, two themes that we are really excited about. So the first one, and by the way, they both kind of relate to what's going on in the political landscape right now, because the first one is this focus on multi-pronged national security. That means traditional defense, sure, but also cyber defense, and also like this emphasis that's being placed on supply chain reorganization via tariffs and energy supply resilience. Second theme that I would be remiss not to mention is, of course, artificial intelligence. All the more so after this week's announcement of the Stargate project, which is aiming to fund AI infrastructure with investment of $500 billion doled out over the course of the next 4 years. Even if you kind of push aside the hype from politicians, this, I think, is good news for the AI supply chain, and it really underscores this idea that as investors, we should be broadening our perspective beyond just kind of the chip makers and the hyperscaler companies that have been at the center of the AI rally so far, and also consider opportunities, in other areas like data center infrastructure, the build out of the power grid, and even eventually AI productivity beneficiaries.
Well said, and thank you for that. So Sarah, I think we've got one last question for you as we get towards the tail end of this call, and it really just comes with the RMDs. And I think back to that comment I made earlier about a moving goalposts, depending on when you were born, there's just some different changes. When do I need to take my RMD? Is there a quick answer to that one?
There is. It does depend on when you were born, but if you were born before July 1st, 1949, your RMD age is 70.5. If you were born between July 1st, 1949 and 1950, the RMD age is 72. Between 1951 and 1959, the age is 73. And then if you were born in 1960 or later, your RMD age is 75.
Perfect. Thank you so much for that. And then Elise, just one last question to ask you as well here. And, we talked about a lot of different things, some positive, but there's also always, what's the next shoe to drop? What are we always worried about potentially? And when you think about just risk, and this goes back to fortifying portfolios, one of your first comments you made on today's call, how do you think about just, building out that portfolio that's resilient, that has protection in there? Just some thoughts as it relates to risks that are out there.
Sure thing. I think first and foremost, we have to remember that risk, quite frankly, comes with the territory of being an investor, especially an investor in the stock market. Volatility is very normal in the stock market, and the stat that I always kind of come back to is that since 1980, the S&P 500 has seen an average intra-year drawdown of 14%. So in any given year, S&P 500 typically sees like a 14% sell-off, but still, even despite those bumps along the way, the index managed to finish higher than where it started in about 75% of the years in the observation period. So remember that it's normal and sort of remind yourself of that to control your own psychology. But in terms of specific assets you might consider to have as defensive buffers in your portfolio, I think it really depends on what it is you're trying to defend against. For example, if it is, a growth scare or recession fears that we want to defend against, we still think that core bonds are going to have your back and be a good diversifier to stocks there. If it's concerns around the sustainability of U.S. government debt, then I mentioned earlier that something like gold might be considered in the context of a diversified portfolio. For general insulation against stock market volatility, there are a lot of different things that you can do. And, if you are a eligible investor, you might consider something like equity structured notes. But I think really, again, going back to that big picture and our underlying philosophy of the way that we build portfolios, the best thing that you can do to help weather those kind of market volatility bumps that come along the way is to just have a really intentional, well thought out plan that is aligned with your goals. And of course, our JP Morgan advisors can help you build one.
Perfect. Thank you, Elise. I think that was a perfect tee up for our great advisors that invited everybody to this call. And when we wind down this call and we think about risks, right, at the end of the day, there are always things that come up every single year as a reason not to invest. And when we think about that, and if we can add the next slide here, that at the end of the day, as we wrap all this up, there's always a reason or there's always something to worry about, right? Investment portfolios are built to last. What you're looking at on this page, everybody, is just going back to 1999. You'll see that in the left column there. The different things that come up year over year over year that should scare us, create uncertainty. But at the end of the day, we also know that markets are resilient. And if we have a plan, we stick to that plan, we work with our advisors to maintain that plan, and then we build out a thoughtful asset allocation, diversified well enough based upon your risk tolerance, that we can navigate through those types of uncertainties and circumstances. So at the end of the day, I hope everybody enjoyed this call. We tried to get to as many questions that everybody provided to us. We can't thank you enough for the interaction here. Thank you for the trust and the time that you provide here with us here at JP Morgan. Have a wonderful rest of the week, everybody. Thank you so much for your time. Elise, thank you. Sarah, thank you. Have a great day, everybody.
If you are considering any investment or strategy, you should always do your research before making any investment decisions. Investment products are not bank deposit products, which means they are not guaranteed by a bank, not FDIC insured, and have risks, like the possibility of losing money on your investment.